Welcome back to Investing Talk Podcast.
Today we're looking at Lucid.
As usual, before we start, subscribe, like, and comment to this video to support the show. If there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Lucid is maybe one of the most interesting financial tightrope acts in the market today.
A tightrope act. I like that.
It really is. It's this paradox that's so extreme, it's almost, hard to believe. You've got this rapid operational momentum.
Which we'll get into.
Exactly. Backed by a massive sovereign wealth fund. But at the same time, they are losing a catastrophic amount of money on every single car they sell.
And that's really the core question we need to answer for you today, isn't it? Is Lucid fundamentally an infrastructural play that's backed by a whole nation?
Right.
Or is it just a hyper-luxury car company that's, frankly, burning cash way too fast to ever become viable? We have to tackle this financial tension head-on because the numbers, they're pretty stark.
Let's start with the operations, because the acceleration is real. It's undeniable. If you look at the Q3 2025 results, revenue hit $336.6 million.
And that's not just a little bit of growth.
No. That was a dramatic 68% year-over-year increase from Q3 2024.
And the production numbers were even more staggering.
Oh, absolutely. Vehicle production just jumped. It was up a massive 116% year-over-year.
116%.
Yeah. They produced nearly 3,900 vehicles in the quarter, and on top of that, they built over 1,000 additional units that were, specifically for final assembly in their new Saudi Arabia facility.
And getting them into customer hands.
They delivered 4,078 vehicles. That's a 47% increase year-over-year. That 116% production leap, for any manufacturing company, that's just historic.
It is historic, but you asked if this growth is actually a good thing, and that's where the tension really lies.
It does. This volume, it came at an astonishing price. The net loss for Q3 2025, it ballooned to $1.03 billion.
A billion.
A billion, with an operating loss standing at $717.7 million.
Okay, let's just pause on the unit economics here. We need to really visualize this loss for you.
We absolutely do. If you break it down, sales versus expenses, the most critical number you need to hear is this. The company lost approximately $176,000.
Wait, say that again.
$176,000 for every single vehicle they sold in Q3.
Per car.
Per car. Just think about that number for a second. That is the definition of a deep negative gross margin. The materials, the labor, even the factory depreciation, it all costs $176,000 more than what they sold the car for. It's just unsustainable without a clear path to scale.
I hear the bullish argument, though. You have to spend that money to scale up. You have to build out this bespoke infrastructure for luxury EVs.
Of course.
And then eventually those huge fixed costs get spread across, say, 100,000 units instead of 4,000.
I would.
But $176,000 is such a massive gap. That huge growth momentum actually sounds more like an accelerated path to insolvency if the margins don't fix themselves quickly.
That is the core execution risk. They're betting that this massive initial spend on proprietary tech and luxury finish will be recoverable as volume ramps up.
But the market isn't waiting.
Not at all. They already had to revise their full year 2025 production guidance down to 18,000 vehicles, which tells you the execution difficulties in the ramp. They haven't disappeared.
Okay, so if they are losing that much on every car, that should be triggering massive bankruptcy alarm bells.
It should be.
But they seem completely safe. So how do they navigate that kind of cash burn?
And that brings us right to the second critical point. The capital moat. This is why we sort of categorize them as an infrastructural play, not just a car company. They have a total liquidity position.
So much.
A very robust $5.5 billion. And that money isn't just, floating around. It's strategically backed by a sovereign nation.
And what's fascinating is the commitment from their largest backer after the quarter ended, which really solidifies that runway.
Right. After the quarter, they locked in an agreement with Saudi Arabia's Public Investment Fund, the PIF, to increase what they call the delayed draw term loan.
The DDTL.
Exactly. It's basically a massive pre-approved line of credit. They increased it from $750 million to a huge $2.0 billion.
So they've essentially turned the PIF into an on-demand, high-security ATM to fund their next 2 years of growth. What does this really mean for their immediate future?
It means they have a cash runway that extends comfortably into the first half of 2027.
Wow.
So this instantly eliminates any immediate concerns about bankruptcy or, needing to scramble for emergency financing, the PIF isn't just a lender. They're the largest shareholder. They own 55%.
So this is more than just a loan.
It's an unequivocal institutional vote of confidence in the company's long-term plan, even while it's bleeding cash on every sale.
But hold on, isn't relying so heavily on one single sovereign backer? Isn't that a risk in itself? What if geopolitical priorities shift, or if the Saudi government decides the EV transition isn't moving fast enough for their whole Vision 2030 plan?
That's a legitimate variable. A traditional investor absolutely has to account for that. However, the PIF's commitment runs very deep because Lucid is instrumental to Saudi Arabia's national goals.
Diversification, industrialization.
All of it. And the competitive advantage this creates is key. Lucid can now confidently outspend its cash-constrained rivals on R&D for the next 2 years without having to go back to the equity market and dilute shareholders. That's a luxury very few competitors have.
So let's shift gears and look at what they're spending all that money on, because the technology is the real reason the PIF is backing them so heavily.
Exactly. Lucid's core moat isn't just a sleek design, it's deep engineering in the powertrain. They have proprietary EV battery tech that really sets them apart in efficiency and range. And that tech is being leveraged immediately in the new Gravity SUV.
The Gravity SUV, that's the next major inflection point for their financials, right?
It is. Starting at $81,400 for the touring trim, it's aimed squarely at the highest margin luxury segment. It's competing directly with the Tesla Model X and the Rivian R1S.
And targeting that high-end market is crucial for them to start clawing back some of those negative gross margins.
And beyond just selling luxury cars, the technology is creating future optionality. We saw that 2025 collaboration with NVIDIA on AI chipset.
Right, for autonomous driving.
Exactly.
Yeah.
It positions them really strongly for advanced AV functionality. They're building a full software stack for the future, not just bolting on a system from someone else.
Yet if you connect that software ambition to the bigger picture, it helps justify that 2025 partnership they announced with Uber for robotaxis.
Right, though that's still a ways out.
Sure, that revenue stream is probably 2 to 3 years away. But it shows they're not just thinking about selling cars at a dealership. They're looking at commercializing their technology as a service. That's a potentially massive, non-traditional revenue stream.
And this all comes back to the question of current demand for the Gravity. It's an expensive vehicle. Most of the versions are priced well over $100,000.
Yeah.
Despite the price and the general market slowdown, they're reporting strong demand.
Well, what stood out to me was a great little anecdote that really confirms their competitive positioning at that high end.
Just trade-ins.
The Rivian trade-ins, yeah.
Right.
They captured quite a few
Yeah.
in 2025, over 100 requests.
And why should we care about 100 trade-ins? It sounds small, but it validates their tech and their pricing power.
Absolutely.
Rivian buyers are premium, they're tech-savvy EV enthusiasts. If they're trading in a really desirable truck or SUV for a Lucid, it means Lucid's high-end moat, the efficiency, the speed, the luxury, is actually translating into market share capture. That's essential validation for the Gravity's high price point.
Okay, now let's shift focus to the market. Because the fundamentals are, as you said, a high-wire act. But the stock price action has been absolutely brutal.
Brutal is the right word. The stock is trading near its 52-week lows. It fell a painful 64 to 65% throughout 2025. This isn't just a dip.
No.
This suggests what technical traders call a capitulation-level decline. The extreme pessimism has shaken out most investors, leaving, mostly short sellers betting against the company.
So is there any kind of technical bottom after a decline like that? And why do we care about a specific number, like the $11 floor?
Technical floors serve as psychological anchor points, especially for institutional money. That $11 level has been flagged as the floor where contrarian value funds start to accumulate. For anyone looking for a near-term signal, a sustained breakout above, say, $15 or $16 is key.
And what would that do?
If they clear that resistance, it would likely trigger a pretty significant short-covering rally. The whole technical picture would shift from a downtrend to a consolidation.
But the operational momentum heading into the end of the year, it offers a visual counterpoint to all that market pessimism.
It does. We heard concrete reports that Lucid hit a record 1,000 vehicles per week in December 2025.
And this was just a rumor.
No, we saw visual evidence. 27 car carriers loaded with Gravity and Air models spotted leaving the manufacturing plant. This confirms the production bottleneck is loosening up and building serious momentum right as we head into the crucial Q4 results.
That production momentum is the life raft, but they are still fighting some significant headwinds that, justify that bearish sentiment. We've seen analyst downgrades, And macro issues like losing the federal EV tax credit eligibility, that certainly doesn't help demand for their lower trim models.
And we can't ignore the execution risk. This is critical for a luxury brand. Customers have been reporting persistent, really frustrating software quality issues in the Gravity SUV.
Like what?
Things like key fob failures, navigation errors. When you're selling a vehicle that costs over $100,000, the software needs to be absolutely flawless. These glitches create real risk for the Gravity's production ramp and for their brand reputation, which is incredibly fragile in the luxury space.
So if you're an investor considering this, you need to know the timeline. What are the key events that could either validate this growth story or send the stock lower? What's the catalyst calendar for 2026?
The immediate catalyst is coming up fast. Early January 2026, the Q4 2025 production and delivery report. That's the moment of truth. We'll see if they actually met that revised 18,000 vehicle guidance for the year.
And then the next big financial checkpoint.
That'll be the Q4 2025 earnings release, probably late January, early February 2026. That's where we'll get the updated 2026 guidance, and most importantly, we'll see the gross margin trajectory. Is that negative $176,000 per car getting better, or is it getting worse as they scale?
But the midterm game changer,
Yeah.
the thing that unlocks the real volume and gives them a path to viability, has to be the midsize platform.
It absolutely is. The mid-size crossover reveal is scheduled for the first half of 2026. This is crucial. It targets the more accessible $40,000 to $60,000 segment.
That's the volume segment.
Exactly. It is
Thankfully.
absolutely essential for scaling production beyond the ultra-luxury niche. It's the only way they can recover those massive infrastructure costs.
So what's the profile for an investor who's interested in Lucid right now?
This is an investment for patient capital. You need a 2 to 3 year horizon. And you must have an extremely high tolerance for near-term execution risk, especially around those software issues and the negative unit economics. It's best suited for, a contrarian value seeker who believes the structural backstop is a form of insurance and that the tech moat guarantees future success.
So to synthesize all this risk and reward, Lucid is currently operating like a high-risk startup, losing, $176,000 per car, a terrifying figure. But that cash burn is fundamentally mitigated by the operational acceleration they're showing and, critically, by that massive $5.5 billion PIF-backed liquidity cushion. This creates a really asymmetric situation where the near-term worst-case scenario bankruptcy is largely off the table, leaving significant upside if the Gravity ramp and that highly anticipated mid-size platform execute successfully over the next 2 years.
Make sure you subscribe to Investing Talk podcast so you don't miss our next analysis.